Good morning. Welcome to America First Wealth Management Investment Outlook for September 16th. My name is Dan Liu. I'm the Chief Investment Officer at America First Wealth Management. And joining me today is Michael Cheah, Head of Fixed Income and Portfolio Manager at America First. Welcome, everyone. Next slide, Mike. So we have a standard disclaimer that states that we're not giving any investment advice or recommendations here, and our opinions are subject to change depending on market conditions and changes in the market environment. And these are the views of solely of America First Wealth Management team, and please refer to the disclaimer noted here. Next slide, Mike. So we begin, as always, with our outlook and summary of what we think is going to be happening. So we do have a long presentation today, but let's get right to our outlook. So as I've stated last week, still believe that September will be a positive month, even though history says that most Septembers are the worst month of the year for stocks. However, it is an election year where 62.5% of the time, September yields positive returns. And we still believe that the recent pullback that we saw at the beginning of the month is just a correction and a broad upward move, and it's going to be a buying opportunity. Also, the broadening of equity performance in small caps that we've been seeing recently is quite bullish. This week's rally was, we believe, was sparked by Jensen Huang, NVIDIA CEO, who spoke at Goldman Sachs Communacopia conference. And just to summarize, I think the exciting news he said was we're at the beginning of a new industrial revolution, and he's calling it the intelligence industry. And also he's noting that demand for the new generation of the Blackwell chips is quite strong. Demand exceeds supply, and prices remain very high for that new chip GPU. And they are experiencing no further delays in rolling out the delivery of those chips. For this week, we see the Fed being highly likely to ease interest rates and be constructive for additional cuts. The key events of the week look to be retail sales on Tuesday morning and the Fed rate decision, economic projections and press conference on Wednesday. So we'll be keeping a close eye on those events. Next slide, Mike. Just to quickly summarize weekly market stats, as I mentioned, NVIDIA triggered the rally in AI stocks, and you can clearly see it with the NASDAQ 100 stocks, the Russell Growth Index, continue strong performance by S&P 500 and small caps of Russell 2000. It was a good week for growth stocks, but pretty much everything was up across the board. Even fixed income, which saw a continued decrease in 10-year Treasury yields. So it was a good week. The month to date is still largely negative, with the exception of large growth and bonds, but we think we're going to turn to positive territory before the end of the month. Next slide, Mike. This is a slide of the S&P 500. We're showing it against the 100-day moving average, which is showing that we're on a bullish trajectory here. The RSI, Relative Strength Index, which we look at on a regular basis as a timing overbought, oversold indicator, and we're kind of in the not overbought, not oversold, and the strength in the chart versus the moving average to us portends further upside. Next slide, Mike. The 10-year Treasury yield, as I indicated, down 6 basis points on the week, and now down 22 basis points since the start of the year, and it continues to be in a downward trajectory. That should continue to be bullish for bonds and stocks. And next slide, Mike. And we're at this is the yield curve, which shows continued a decline in the yield curve. The bottom light blue chart is the yield curve ending September 13th. See the previous week above that, beginning of the year, and also the end of June on the top. So we see continued decline across all maturity ranges for Treasury yields. Next slide, Mike. We're showing a new chart here. This is a 10 to 2-year spread, which 10-year yield minus 2-year yield, and we're clearly showing steepening since July. So that portends a shift in the shape of the yield curve. So with that, I'm going to turn it over to Mike to let him talk about what he's seeing. Thank you.
Well, here's my outlook in brief. The Fed is easing policy at an unprecedented time when the economy is still very strong. Having observed the market for more than 40 years, I am quite surprised because the Fed in the past had always eased when the unemployment rate moved up sharply. Cost service inflation remains very sticky. And what we are seeing is that the overall inflation has been driven down by cyclical components like energy and food and goods, imported goods. And well, what goes up and comes down, and what comes down goes up again. So if the core service inflation remains sticky and cyclical component move up, that could be a problem. The 2-year note is fully pricing in a recession. To go further below, it would have to expect hard landing. But with the Fed preemptive easing, I think the hard landing scenario is gone. And then finally, gold hit new high. Question is gold still driven by central bank buying, or are we now seeing new buyers that are concerned that the Fed may be allowing inflation to pick its head into the proverbial tent? So economy, look at the consumer spending, right? Very strong, very strong. No sign of dip at all. And previously, when the small business loan availability declined, right? Small businesses fire workers and initial unemployment claims, this is an inverted chart, increases. Same thing here, small business loan availability decline and initial claims increase sharply. And what we have here is the small business loans have declined, but these small businesses are not firing people, and we are not seeing initial claims rising. And whichever business they're thinking about letting people go 3 months ago, now would reconsider because we are hearing Fed going to ease rates, right? If the Fed going to ease rates, and that's going to abort recession. And why fire workers now, pay them severance, and then take the risk that you may not be able to get them back when we're out of the in a year's time, right? So this is a sign of hoarding of workers. Consumer has money, there's wealth. And if you look at the wealth they have in the real estate and the stock that they own directly or through mutual fund, they have wealth, and that allows them to spend, right? Look at this steady uptrend here, right? Previously, when we have a downtrend, that's where consumer slow down. But this time, the wealth effect is still very, very strong. And for those who don't have too much wealth, they can borrow. They can borrow because when you look at the household debt to disposable income, very low compared to where we were. And US total debt service ratio, again, very low compared to where we were. And recently, we have seen how the US consumer borrowing has risen by a lot, 25.5 billion, the most since late 2022. Inflation, well, the media is focusing a lot on the headline CPI, year on year coming down sharply, right, to slightly above 2%. But when you look at the core CPI, right, it is still above 3%, right? The Fed had prided itself about looking at core inflation, and clearly at this level, we are nowhere near the 2% target. And this is the chart that I'm referring to. You look at the blue histogram, core services remain very sticky. And the drop has been due to energy from big positive to a negative, and core goods tapering away, and food also tapering away. Now you see food and energy starting to add back to inflation. The supercore inflation on a month-on-month basis, after a steady few months of decline, have U-turned. And with the Fed rate cut, the economy is going to rebound, and I expect this to continue to rebound. When we look at the sticky price inflation, excluding shelter, right, we see a similar very stubborn and sticky levels, right, refusing to go down, right? Well, the other aspect of why I think the economy is very strong and too early for the Fed to cut rate is that the unemployment rate is just touching the natural cyclical rate of unemployment, right? Previously, it takes a huge rise in unemployment rate above the red line before we see if we see a recession. And initial claims, what we have now is 227,000. And so remember this number, 227, right? And I'm going to look at the previous time period and to avoid this blip here. So 227. So you look at past historical experience, we get ourselves into recession when the unemployment initial claims rises above 350,000. And we are here, 227, right? So we are nowhere near, right, the start of a recession. So monetary policy, well, the market is expecting a lot of cuts into next year, starting in January. And as much as 6 times 25 basis. 6 times 25 basis, that would be 3%, right? 3%. That's a lot. There's a lot of Fed cut price in the market. And the 2-year note, Fed funds rate, and the 2-year yield, we are now at a level where previously it is correlated well with a recession. So in other words, the gap here has fully priced in a recession. The bond market, well, while the asset managers, the mutual fund are long the treasury market, the hedge funds are short the treasury market. So maybe the hedge fund people are seeing something that the mutual fund people are not seeing. And the TLT on a technical analysis has failed to break above the previous high, right, the last few times. So let's see whether this time it will be able to break above. Dollar.
Mike, just a quick correction, 6 times 25 basis points is 150 basis points, not 300, just to
Yes,
minor check there.
Yes,
300
okay.
would be very, very bullish cut. Okay.
Yes, that's true. All right, thanks for pointing that out. Yeah, good catch. All right. So dollar has broken below the 50-day moving average, and now bouncing off the 200-day moving average. And if we break below that, then it could start a new trend. Possibly, the next move could again be led by dollar yen, because the Japanese investors have substantial net asset investment surplus in the past few years, first few decades. So this money could be coming home when they start to see the yen strengthen. So it could feed on itself, right? And we have seen how the dollar yen move together with the interest rate differential between Japan and the US. So we are now seeing US interest rate coming down and Japanese interest rate going up, and the interest rate differential is narrowing. And that usually lead to a lower dollar yen. Gold, as I mentioned, gold hit a new all-time high again, closing at 2,606. And so traditionally, gold moved up on inflationary fear. So the question is this coming back again? All right, Dan, back to you.
Okay. Before I continue, Mike, I just wanted to pick up on a point you had said and had stressed in previous investment outlooks that core inflation is high and remains very sticky. And after seeing the data points for quite some time now, I tend to agree, and probably the Fed agrees. Core inflation is high and remaining stickier. But one thing that's encouraging is I've seen both presidential candidates, Harris and Trump, are attempting to announce policies that would put more dollars into the pockets of employees. For one, the Trump administration had proposed no taxes on tips, and quickly afterwards, the Harris administration said that they would do the same. And then last week, Trump has said that, and I thought this was quite interesting. Never saw this before. No taxes on overtime pay, and that certainly, I'm sure hourly workers are cheering that because creates a huge incentive for overtime, and to earn that overtime pay on a federal tax-free basis would be a huge plus to the bottom line of hourly employees. And I'm sure the Harris administration is going to follow suit with either mimicking that or proposing other changes to personal income taxes. So the trend is, to me, is clear that both administrations want to improve the bottom lines of employees. So if net income after taxes for employees goes up, that's should be able to cover some of the sticky core inflation, which I view as bullish. I'm still trying to find some data in terms of the implications of that, but at face value, it seems to be very positive. Any thoughts on that, Mike?
Well, if there's going to be more spending power, then the economy is going to be stronger, and stronger economy means higher inflation. And the other aspect of this is when the government give away money freely, then money going to come from somewhere, right? If they're not going to raise taxes, then they're going to borrow more, right? So the bond people, should be seeing, two red flags. One, inflation. There's one factor contributing to more inflation, another factor contributing to more supply, right? So the bond people should, be thinking about this is not good. This is not good.
Yes, I agree. Everything is connected.
Yeah.
But if the bottom line of people improves, that's a positive surprise. And what follows in terms of reaction by policy and the Fed are kind of secondary factors, in my opinion. And certainly would give reason for the Fed to slow down on interest rate cuts or potentially even hike if inflation gets out of control. So it's a balancing act. Everything is connected, as we all know, but we have to figure out what will be the factors that are important that change the markets. So,
well, the other thing that's in my mind is the market is expecting a series of Fed cuts into next year, right?
Yes.
But I think as a decision maker, it makes sense for the Fed to do what they want to do this year and then pause in January, February to assess the new fiscal initiative,
Mhm.
right? So for the Fed to just run ahead like a train, right?
Yes.
Okay, right,
Mhm.
without regard to what the
Yes.
government do, I think that's not decision making. I think that is just driving a
Yes.
train.
Yes. Yes. Yeah, nothing goes straight up. There's a lot of news and data that points
Yeah.
that will change things. And this is why we do these weekly investment outlooks, because we assess what's happening on a current basis and try
Mm,
to predict what is coming. And hopefully our viewers are taking advantage and paying attention, because I think we are covering things pretty well, and hopefully we'll get more viewers, and comments are always welcome. Thank you.
mm,
So turning back to our presentation, as we've been showing the Magnificent Seven, huge pop from NVIDIA, obviously, leader of the Magnificent Seven once again, and continuing to be the runaway leader year to date, up 140% plus. Tesla continues to be the laggard year to date, but Tesla also saw a very strong, up 9.3% for the week. Very strong across the board, very encouraging. Apple was the only laggard for the week, and we'll pay some attention to Apple as they are announcing new products shortly. And hopefully the iPhone 16 will be a breakaway new product for them, but we'll pay attention to that closely. Next slide, Mike. U.S. sector performance, obviously tech led by NVIDIA was runaway, up 8.1%. Consumer stocks are strong. Consumer discretionary up 5.5%, and pretty much across the board. The only laggard was energy, down 49 basis points. Energy prices were volatile, down sharply at the beginning of the week, but kind of recovered. As some hurricane concerns increased energy prices as the week progressed, and it was good to see tech up, and we'll see if that continues to follow through this week. And the other sectors were strong as well. Next slide, Mike. Factor performance, IPO, private equity factors, hedge fund names were up strong. Spinoffs were also strong as well. In terms of style, large growth momentum and small cap were the leaders, but pretty much everything across the board on all styles, qualitative and style, were positive. So a very good sign, very bullish in my opinion. Next slide, Mike. Commodities, natural gas was up, gasoline up slightly, but pretty much across the board, energy commodities were down. So and that will be positive if the downtrend continues for energy, but we think that will probably be unlikely. The supply levels, I think, Mike, you've noted that the SPR reserves were at very low levels, so there'll probably be demand to refill the SPR as energy prices come down. One of the concerns about energy is demand. With the slowdown in China, will demand for energy continue to go down, because that will put a negative pressure on energy prices. So we're watching that factor as well. With the continued decline in interest rates and the impending rate cut this week, precious metals led by silver, also gold was up, were up very sharply. Silver up almost 10%, gold up 3.4%. Aluminum had a nice rebound, up 5.5% on the week, and that's hopefully a good leading indicator for some increased manufacturing demand. And we saw an increase in steel and copper as well. So those were bullish in terms of the industrial metals. And also that could be sparked by an increase in demand from the housing sector, because obviously as rates come down, home building and construction and renovation activity tends to pick up. Next slide, Mike. In terms of the agricultural, I see on the bottom, cocoa had a big reversal, which is good news for Halloween trick-or-treaters. Cocoa's down over 20% on the month. But as you can see, up still very strong, up almost 83% year to date. A pop in wheat prices, probably due to some weather patterns occurring around the world, potentially creating volatility on wheat futures. Coffee remains strong, and we'll keep an eye on that. That's going to have some impact on companies, especially like Starbucks, and price of coffee for consumers. And that's pretty much it in terms of what I want to say about commodities. Next slide, Mike. Economic calendar, as I mentioned, Tuesday, 8:30 a.m. Retail sales will be probably a market mover. Previous was 1%. Consensus and forecast 0.2, 0.3%. So we're going to watch for hopefully continued positive retail sales momentum, especially as we're looking at what's happening in the back to school period. And that's Monday, Tuesday. Next slide, Mike. Wednesday, obviously, we do have some building permits data, which we expect to be positive as interest rates have declined. Fed rate decision at 2 o'clock and economic projections. The Fed press conference at following at 2:30 will very a must watch to see what Chairman Powell is saying, and the future stance of the Fed and what they're concerned with. Next slide, Mike. Moving on to Thursday, jobless claims, jobs information, existing home sales. Those will be important to look at. I'm not expecting any dramatic surprises. And Friday, there's a Fed Governor Harker giving a speech. And that wraps up the week for macro data in terms of S&P 500 earnings. A light week as well. Pretty much, I'm sorry, I think I got the dates wrong there. The 19th and 20th, I think, are Tuesday and Wednesday, not Thursday. So it's really just Tuesday and Wednesday. Got General Mills, Darden Restaurants, FactSet, FedEx, and Lennar, and kind of expecting some mixed earnings coming out of that. General Mills seeing down earnings from a year ago, Lennar being down a year ago, Darden, FactSet, and FedEx looking for improving up earnings versus a year ago. Next slide, Mike, and that brings us to our end for, we welcome viewers and interested parties to contact us. We'd love to hear your feedback and your concerns, and hopefully you're finding our weekly outlooks useful. And if you want to learn more about our products or services, please contact Cleveland Ashley, our regional director of sales, and his information is listed here. And our website is AmericaFirst.fund. And with that, thank you for tuning in. And Mike, if you have any final closing comments, please share them. And otherwise, thank you everyone for joining us.
Oh, thank you, and see you guys next time.
Thank you.